Hello and welcome to our conversation on financial reporting. In this session, we will examine the buyback of shares and understand the buyback of shares by TCS as an example. The buyback of shares is a strategic decision. Um, It's, it's a decision in which company repurchases its own shares from the market using the cash available on the balance sheet. So buyback is a process of capital reduction by acquiring the shares from its own shareholders. Since a company cannot be its own shareholder, so the shares repurchased are either cancelled, which is the case in India, or sometime in some cases it will be held in the company's treasury as a treasury stock. Buyback is a highly regulated um, transaction. Both the Companies Act and the SEBI's regulations are there, which governs the entire process of buyback. There is an elaborate procedure been laid down in the Companies Act under Section 68, 69, and 17, and also the Rule 17 of the Companies Act. They deal with the buyback of shares. The conditions given in these regulations of that the buyback should not be more than 25% of the total paid up capital and free reserves of the company. Moreover, it also should not exceed 25% of the paid up equity capital. So if you see these two conditions, one talks about the value of the buyback, which will also have an effect on the price at which the shares are bought back. And the second condition throws light on the number of the shares. So these conditions talk about the value and the number. The second condition, the third condition is to protect the interest of the debt holders. So it says that the debt equity ratio post buyback should not be below 2:1. In other words, the debt should not exceed twice that of equity. In order to protect the debt holders, this condition says that post buyback, the company should not be excessively leveraged. And whatever shares when been bought back, it is important to realize that they have to be fully paid up. In other words, a partly paid up shares cannot be bought back. Only one buyback is allowed in a year. And it's important, at least in India, that the shares bought back must be physically destroyed. So the company cannot hold those shares. And no fresh issue is allowed within 6 months for the buyback of the same class of shares, except, of course, ESOPs or the sweat equity or bonus shares, which is distribution of dividend or conversion of debt and preference shares into equity. Moreover, one should also remember that buyback is possible only when there is a positive reserves on the balance sheet. What is the purpose of, what is the objective of the buyback, and what is the impact of buyback on the balance sheet? Buyback often leads to increase in the promoter's holding. It increases the earning per share because the number of shares goes down. It also is expected to increase the share price. Buyback is also a means to pay surplus cash available on the balance sheet to the shareholders. If the companies realize that the cash available on the balance sheet is not required in the near future, instead of keeping the idle cash on the balance sheet, often companies decide to give back that money to the shareholders. And it's also been said that buyback is a means to reward the shareholders. Can be often the price at which the shares are bought back is much higher than the market price. And since it increases the promoter's holding, it's possible that buyback can be seen as a means to safeguard against a hostile takeover. So, so therefore, buyback is not a normal technical or operational decision. It is to be seen as a strategic decision. Let us take an hypothetical example to understand the impact of the buyback on the financial statement, that is the balance sheet, income statement, and cash flow statement. To do that, we have taken a very simple balance sheet with an opening balance sheet which has the assets and the corresponding sources, and observe the corresponding sources as capital, the retained earnings. So therefore, at this juncture, the company's equity before buyback is equal to 200,000 plus 650, that is 850,000. That is the equity of the company. The debt of the company, the long-term debt, the debt of the company is 100,000 plus 200,000. So the debt is 300,000. So the debt equity ratio, which is one of the conditions of the buyback, is way below the ratio of 2:1. So therefore, the company is in a safe position to go for the buyback. So let us now go for the transactions, and let us observe and complete the financial statements to understand the impact of buyback on the equity, the debt equity ratio, cash, and many others. So we have the normal transactions like sales. Okay, the company sold goods to the extent of 600,000, and this is for cash. So there is a receipt, and whenever there is a sale, there has to be cost of goods sold. So the stock will reduce to the extent of 120,000. And during this period, the company has paid rent, and rent is an expense. And we also, let us assume that the rent has been paid. Otherwise, you would have created a liability. And there are no other direct transactions, but we should also observe there are two liabilities, 10% convertible bond and 12% loan. So there is a need to show the interest because of the accrual principle, and interest on convertible bond and interest on the loan. We assume that we pay in that period. But if we don't pay, we can create a liability. Since no information is given, so we have assumed that the loan has been paid. So since all transactions have been done, so we will find the profit before tax. 204 is the expenses, and the PBT is equal to the income minus the expenses. So PBT is 396. And let us assume the tax to be 25%. Tax is 25% of PBT. And let us also assume that we pay the tax at the end of the year. So the PAT is equal to PAT will be PBT minus the tax. Right, is equal to PBT minus tax. If no other transaction would have been there, we would have transferred the PAT fully to the retained profit. But for the time being, we will complete these two transactions, then close the balance sheet. Now let us focus attention on the buyback of shares. So the number of So let us do a working mode here, okay, for the purpose of the buyback. And working mode for buyback will show the number of shares to be bought back. The number of shares, buyback shares will be the number of shares to be bought back is equal to number at present the total number of shares are 200,000 divided by 5. The bought back shares will be 10% of it. Okay, so 4,000 shares to be bought back. The bought back price, the price is equal to 50 is given. So therefore, amount payable for buyback is equal to amount payable is equal to 4,000 multiplied by 50. Let us also observe that the amount payable is less than is around 23% of. Okay, so amount payable is 2 lakh. So the amount payable as a percentage of equity is equal to 25% or 23%, which is below the cap of 25% of equity. Okay, and we have taken at the opening equity, if would have added this fact, these percentage would have been much below. The number of shares bought back is also below the cap of 25%. The face value of the shares bought back, the face value of the shares bought back is equal to 4,000 into 5. The premium on the buyback is equal to 1,80,000. So these are the relevant numbers which will help us in completing the financial statement. So the buyback will affect the cash flow statement because to the extent of the money paid will be shown as a cash outflow. So buyback leads to reduction of capital and reduction of cash. So let us see what is the effect on the capital. Capital has come down from 2 lakh to 180,000. And the premium on buyback is normally reduced from the retained profit. We know that the retained profit is equal to the retained profit is the accumulated profit which will be used for the buyback of shares. Any excess paid will be adjusted against the premium. So we can observe that the retained profit is equal to the 650,000 plus 297,000 minus the premium. Minus the premium. Okay, so there is no change in the convertible bonds, no change in the loans. Okay, there is no change in the convertible bond, no change in the loans, no change in the creditor. However, there is an accounting condition for buyback, which is not mentioned in our PPT. So the accounting condition is amount to the extent of the face value of the the shares bought back will be transferred from the retained profit to the CRR. CRR is a capital redemption reserve. Let us revisit the retained profit. The retained profit is equal to opening retained profit plus PAT minus the premium on the buyback of shares minus the amount transferred from the retained profit to a special reserve account called capital redemption reserve. Capital redemption reserve. No change in any other asset. So therefore, the shares of M Limited stays as it is. No change in the debtors. And of course, the cash is going to change. We'll find out now cash in hand. Cash in hand is equal to cash available, which is 1 minus the cash payments. The cash payments, before that, let us pay the tax. Okay, let us pay the tax. Okay, otherwise create a liability. So the tax payable is 99,000. The summation of this payment is 383,000. So cash in hand is equal to cash available minus the cash payment 697,000, which is an asset and will appear on the balance sheet. Now we can sum up the total sources and total assets. The total sources is equal to 1.3 million, and the total assets will also be equal to 1. But observe, let us revisit the buyback. That is why I put it in red. So the buyback leads to reduction in the capital. Buyback leads to reduction of cash to the extent of the amount of buyback, and the amount of buyback is equal to the face value plus premium. In this case, the premium is 180,000 and the face value is 20,000. There is also an effect on the reserves, because to the extent of the amount bought back at a premium is adjusted against the retained profit. So buyback affects the balance sheet and cash flow statement. It affects the balance sheet because the equity is going to change. Equity is going to change. We can see that equity of the company has changed here to a large extent because of the effect of the retained profit and buyback. There is no change in the debt. There is no change in the debt. So the debt equity ratio has also reduced further. Or in other words, the debt equity component, the equity component has gone up and debt has remained constant. The very purpose of the conditions for buyback is to protect the interests of the debt holders. So we can see that the buyback is therefore an important business decision which affects the cash flow. To summarize, buyback leads to reduction in cash, buyback leads to reduction in capital, and buyback leads to reduction in reserves. So buyback is an important strategic decision of the company. Now let us take an example. One of the largest buyback happened in the recent past is the buyback of TCS, which happened in the month of February 2022. So let us observe the TCS impact and all the details of TCS buyback of 2022 are available on the website, and we can see the details, the proposals of the buyback, the approval of buyback by the board, the notice given by the buyback, advertisements, and so every detail of it's mandatory that a company has to provide all the details relating to the approach, about the price, about the impact. So what we will try to do is pick up because already the transaction has happened, we'll pick up the post buyback announcement so that it will tell us exactly what has happened because of the buyback of shares. So this is a summary. This is a summary of the public announcement of the impact of the buyback of shares by TCS. So TCS has announced the buyback as per the regulations of the SEBI, buyback of securities regulations of SEBI, and that was in the month of February 2022. And the letter of offers were given to the shareholders whether have agreed to tender or sell the shares in March 2022. So therefore, March 31st balance sheet of TCS will have an effect on, will have the effect of the buyback. What was that transaction? The buyback of shares was TCS announced is 4 crore shares. So the company announced to buy back up to 4 crore shares, fully paid up shares. With a face value of 10, The face value of the share was rupee 1, and of all from all the shareholders who were on the record on February 23rd, 2022. And the price at which the share buyback was decided was 4,500. And it's important to understand and know that on this date, the announcement date, the price was, the market price was way below 4,500. And so as a result, 4 crore shares to be bought back or were bought back at the rate of 4,500. So cash outflow from the company was 18,000 crore. So capital reduced to the extent of 4 crore because face value is 1, but cash has gone down by 18,000 crore. So therefore, 18,000 crore minus 4 crore is the balance, is the premium paid for the buyback. There were other minor expenses for the buyback, which is excluding 4,500. It's also important to remember and observe that the conditions given by the SEBI were also fully fulfilled. So the prescribed limit of 25% and also the paid up capital and equity capital were also fulfilled. And as such, TCS is not a levered company, so the debt equity ratio issue is also been fulfilled. So 4 crore into 4,500 is 18,000 crore. And it's important for us to ask a question: who are the persons taken this money? Okay, so let us understand the major shareholders of TCS who have actually sold the shares and benefited from this buyback. Two of their largest shareholders are Tata Sons Private Limited, which is a promoter, which was hold, and Life Insurance Corporation. So Tata Sons sold about 24 million, 2.4 crore shares, and Life Insurance Corporation sold about 1.1 million shares. So out of the total buyback, about 64.9, that means 65% of the shares bought back were from these two large shareholders. So we can also understand that out of 18,000 crore, around 11,000 to 12, around 12,000 crore money has gone from TCS to Tata Sons Private Limited. So that means cash has gone from the balance sheet of TCS to the balance sheet of Tata Sons, which is a private limited company, which is not a listed company. So somebody can argue that buyback has actually benefited, buyback by TCS has actually benefited the largest shareholders of TCS, that is Tata Sons Private Limited. And moreover, there is one more benefit that Tata Sons got, that we can see post buyback, the shareholding pattern. The pre-buyback, Tata Sons, that is the promoter, was holding about 72.19%. But post buyback, the stake of the promoter has gone up from 71.19 to 72.30, whereas the other shareholders, including the public and individual financial institutions, has gone down marginally to 27.7%. So we can observe that Tata Consultancy, TCS, has paid a big amount of premium over the market price. The face value is 1. The market value at that time was around 3,500, but the price given for buyback was 4,500. And there was an outflow of cash of 18,000 crore from a listed company out and a significant part of 18,000 crore, around 11,200 crore, has been transferred from TCS to Tata. So that is the summary of TCS buyback, and we should keep on observing not only just TCS buyback, but other companies buyback to observe who is benefiting from the buyback. Of course, small shareholders also benefit because the price given um, for buyback was much higher than the market price. So let us go back to see once again. So therefore, Tata TCS also helped in increasing the promoters' shareholding. So this is an important observation that we did, and it has used the cash available to give the surplus cash to the shareholders. So so therefore, somebody can raise and understand it requires a critical examination. Is buyback a means to transfer the money from the company to large shareholders? So it is worth examining who actually benefits from the buyback. Otherwise, um, buyback is, as we mentioned here, buyback is a process of capital reduction, and it helps the company to by increasing the earnings per share, and it helps the company by improving the price of the shares too. Thank you very much.